Investing for the long term is one of the surest ways to grow wealth, and retirement planning is something that every investor needs to be thinking about. A chunky stocks portfolio can be good for growth, and if you're smart, you can get it to pay you a decent income too, but during your retirement, it could be subject to too much market volatility. The last thing that you need is for your carefully grown investment pot to half in value on retirement day.
That's where the Vanguard Target Retirement Funds come in. Alongside Vanguard LifeStrategy, these are among the best ready-made portfolios that are good for a lifetime. By de-risking your portfolio in line with your target retirement date, they behave similarly to a pension fund. But this doesn't have to be bought through a pension. It can be bought through an ISA or a general account. So it has the same flexibility of access of any other fund, and you can sell out of it at any time.
With a target retirement date in mind, the Vanguard Target Retirement Funds are an excellent investment for beginners and those who just want to invest and forget. So are the Vanguard Target Retirement Funds right for you? Let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Vanguard Target Retirement Funds, the basics. They are basically ridiculously cheap funds which hold other ridiculously cheap Vanguard funds that change their asset allocation as you near your target retirement date. The asset allocation is how the investment is apportioned across equities and bonds with the aim to balance risk and reward.
Their strategy is to reduce your risk over time by reducing your exposure to risky equity and gradually replacing a portion of it with bonds. Let's look at this again. Vanguard take the view shared by so many in the industry that the best portfolio for an older person is to hold a majority allocation in bonds.
When you're young, you can afford the risk of having much higher performing shares because you have time to build back up again if there were a market crash. These funds are advertised as an investment for retirement planning, but they can actually be used for any target investing date, such as investing for a child's future wedding or your dream car.
If you want a fund that aims to grow fast in the early years and then shift tack to protect your wealth in the years before the target date, then these Vanguard funds might be just what you need.
Why are there more than one fund? Just to be clear, this isn't one fund. There are numerous funds available that are all essentially the same except for their mix of stocks to bonds, based on the target end date you have in mind. You simply choose the one that is right for you.
Here's 10 variants of the fund. The ones that target 25 years or more in the future have a healthy focus on shares, whereas if you want to retire sooner, then the mix shifts towards bonds. Now let's look at why this particular investment is so good.
Simple. The beauty of the target retirement funds is that you can just invest and forget. You don't need to manage your own portfolio, and you don't need to remember to de-risk it in the future. It's all set up to do that for you automatically. These funds are great for those who know that they need to be investing and want to protect their futures, but aren't necessarily passionate about the subject.
Diversification. Most funds are generally well diversified, as this is a fund of funds. You get access to huge diversification in one purchase, which is great for those who don't want the hassle of managing their own portfolio themselves.
You will get exposure to worldwide equities and bonds. Here are the underlying funds within the Vanguard Target Retirement 2055 fund as an example. You can see that most of it is from non-UK stocks, which is ideal because you want exposure to the whole world market, but there is a good chunk of UK stocks in there, 18.1% to be exact.
Note that there is a UK bias in this portfolio of funds, since a properly global portfolio might have more like 5% UK. But we ourselves are guilty of UK bias in our own portfolios because it's our home market. This isn't necessarily a problem, just something to be aware of.
Low cost. This goes without saying. All funds have fees, but Vanguard know the importance of low-cost investing and can be trusted to drive down fees for investors. The ongoing charges figure is just 0.24%, meaning you can invest £10,000 and only pay fees of £24 per year.
Your target date. As there are a number of target dates to choose from, you can set your own target retirement date. A financial advisor could do something similar, but you would pay through the nose to achieve it.
Vanguard's site even has a calculator which advises you which fund to pick based on the average retirement age. You can of course ignore this and pick a different fund with a different end date. With a Vanguard fund, it's on your terms.
So, what we don't like. Our main criticism is less to do with the fund itself and more to do with the concept.
These funds follow the glide path strategy to de-risk and reduce likely volatility over time. They then expect you to start eating into your capital. Once upon a time, this was considered a good retirement strategy, as life expectancy was short after reaching retirement age. Most retirement planning was done through pensions, and you were forced to buy an annuity with your pension, so it was important to avoid market volatility.
However, today you're free to spend your retirement pot as you please. For us, we would hope to build such a large investment pot that we do not need to spend the capital and could live on the income alone.
Therefore, as for funds, look to simply maintain your capital in the later years rather than keep it growing due to the de-risking. This is not something that either of us like to invest in.
Because we are flexible with our retirement dates, a badly timed stock market crash might just mean we need to work a little longer. If you need to retire by a specific date, then wealth protection might be for you.
Alternative solution, Robo Pensions. The Vanguard Retirement Fund might look like a pension, smell like a pension, but it is not a pension. If you don't know whether the Vanguard Target Retirement Funds are right for you, you could look at a robo investing platform like the Nutmeg Pension instead.
The Nutmeg Pension works out your risk profile and investment style and assigns you a pension portfolio based on your choices. Holding your retirement fund in a pension means that you get to claim back income tax during your working life and add it to your pot.
When you work, you get taxed, but this is recognised by the taxman when you save into a pension, as he will give you that tax back. Save £100 into a pension and a basic rate taxpayer gets it topped up by £25. A higher rate taxpayer would get an effective top up of £67 for every £100 saved.
If a ready-made pension with Nutmeg sounds like it's for you, if you open an account with the offers link on moneyunshackled.com, you will get your first 6 months with 0 management fees. Pensions are great for building pot size, but those that want the flexibility to access their cash early may want to opt for the Vanguard Target Retirement Fund in an ISA instead.
What is the past performance? Here you can see the performance of the 2055 fund over the last year. It looks the same as any fund tracking the world equities market right now. What sets this Vanguard fund of funds apart from a competition is the dirt cheap fee and the glide path strategy.
Let's look at how the returns on the 2055 fund compare to the 2025 fund, which would have more bonds in it. The 2055 fund has a 48.7% cumulative return since inception in December 2015. The 2025 fund returned 42.1% over the same period. Not bad. There is of course no guarantee that this will continue, but if you believe in the world economy as we do, then these funds are likely to do well.
Due to the glide path model, the returns were bound to be lower on the 2025 fund, but that's still a good haul. We suspect that over the long term, bonds wouldn't do quite so well as this. We think the recent good performance of bonds is due to quantitative easing and record low interest rates.
How to invest? You can invest in this fund using the Vanguard platform, which in itself is very cheap, and we'll put a link to the website in the description below.
Alternatively, you can invest via an independent investment platform such as Interactive Investor, which we'll also link to in the description below.
Question of the day: how are you managing your retirement strategy? Let us know your top tips in the comments below. Thanks for watching. On this channel we talk about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.